Most people choose mutual fund by past returns. That's the trap because a fund can show great past return simply because it became more expensive. Then you buy it and later you feel stuck with slow returns. In the next few minutes, I'll show you one simple number that help you avoid that mistake. You will have a 30-second checklist. So before you invest, you can quickly tell, is this fund looking pricey or reasonable valued? Even better, today itself, you can check any fund in under 1 minute and get a clear answer. Three things today. What PE really means, how to use it in mutual fund in three steps, and when a lower PE can actually be a good time to accumulate. First, PE in simple language. PE is like a price tag. PE means price divided by earning. Earnings means profit. If a company earns 10 rupees per share and the price is 150, the PE is 15. So you are paying 150 today for 10 rupees of yearly profit. That's all PE is, a price tag. Quick check. High P means more expensive, lower P means cheaper. Now for mutual funds. A mutual fund PE is usually the average PE of all the stocks it holds based on their weights. So fund P equals the average price tag of all the companies inside. PE is the price tag. Fund PE is the average price tag of its holding. Now, here is the key mistake most investors make. They see low P and think nice and cheap. But low P can happen for two different reasons. Number one, price fell because people are scared even though businesses are okay. Number two, profit jump temporarily. So P looks low, but it's not true cheap. That's why we use a method. Here's a three simple step method. Number one, compare the fund's P with the benchmark. Benchmark means the index the fund is compared to, like Nifty 50, Sensex, Nifty mid cap, and Nifty small cap, and so on. And compared in the same category, large cap with large cap, mid cap with mid cap, small cap with small cap. Example: fund P is 30, benchmark is 20. That's a premium about 50% higher. Does that automatically means the fund is bad? No, it means you are paying a higher price tag than benchmark. Ask, am I paying more than the benchmark for this fund? Step 2. Compare today's fund P with the fund's own history. Look at its normal range over the last 3 to 5 years. If a fund usually stays around 18 to 20 and today it's 28, it clearly shows expensive compared to its own past. Higher price tag means higher expectations, so returns can feel slower if market cools down. Ask if this fund expensive compared to its own history. Now, where do you find portfolio P? Usually in the fact sheet under portfolio characteristics or fund metrics. If it's not there, check the AMC fact sheet. AMC means asset management company, the fund house. Okay. Now, number three, don't use P alone. It with growth. Growth means profit growth over time. Example, Fund A PE is 28, profit growth is around 20%. Fund B PE is 18, fund growth is around 6%. Fund A is expensive but growth is stronger. Fund B is cheap but growth is weaker. So PE is the price tag and growth is what you are getting inside the packet. If the price tag is higher, the growth quality should be also higher. This is very important. A quick myth busting. Number one, low P is always safe. Not true. Sometimes it's cheap for a reason. Number two, higher P is always bad. Not true. Quality and growth can deserve a higher price. Now the practical part, historical P and accumulation. Market moves in cycle. In fear phase, bad news, panic selling, price fall fast, and even good companies fall. So P comes down. Historically, those period can be a better for accumulation if your time horizon is long. So when can a lower P a good sign of accumulation? There is a simple filter. Number one, P is lower mainly because price fell, not because profits are permanently damaged. Number two, P is lower than its long-term normal zone, not just lower than last month. And the biggest rule, accumulate in parts. Don't try to catch one perfect bottom day. Continue your SIP, and if valuation look clearly cheaper than usual, add extra money in two or three small parts over a few months. This reduces timing risk, but one important warning. Sometimes P looks low because profit jump for a short period of time. This happens in cyclical areas where profits moves up and down quite few times. So the P looks cheap for a while and later it doesn't. So don't treat every low P as a bargain. Use the method. Now your 30-second checklist. Number one, fund P versus benchmark P. Number two, fund P versus its own past range. Number three, if PE is high, is growth clearly strong? Number four, if PE is low, is it low because of fear or because profit are unstable? Final question before you invest. Is my fund pricier or cheaper than the benchmark? Is it pricier or cheaper than its own history? And does the growth justify the price tag? Final conclusion. P won't predict the market, but it can stop you from buying a fund at an expensive price tag just because past returns look good. Use P like a price tag, compare it properly, and accumulate slowly in the phases when valuations are cheaper than history. If you have any questions about the fund or how to apply this method, put them in comments and we'll try to answer. Thank you very much. See you in the next video. Thank you.